So this is a balance sheet. And like I said, usually when I'm testing you for a balance sheet, I'm most likely going to like either give you a balance sheet template that looks like this in your answer book, something that looks like this. So if you're doing past papers, you will notice that it's either they give you a template that is complete and it looks like this, or they will give you a template that just like have a few missing things and now you need to just like figure out the rest. So like I said, format. If you know the format in any topic in accounting, then you are standing in a good position of doing really well. You get it? Or if you fumble around the calculations, at least if you know the format, like inventory, you get it. So you know that current account, current assets, you have your inventory, you have your trade and other receivables, and you have a cash and cash equivalent. You get it? Which means that this template, if you know it, you get a format, then it means what? It sort of helps you or guide you exactly where to look for the information. Like when you're talking about inventory, then it means that for all the information that you are given, you are going to be focusing on what? Inventory, anything that is inventory related, and then you have to do the calculations. You get it? So again, with the balance sheet also, in this regard, and many activities, usually we don't ask you to prepare the notes. You get it? So if it happens that you go into an exam and then you find out that I'm asking you to prepare maybe the balance sheet and a current account note, you get it? And then I'm expecting you to somehow like the calculations where there would have been a note, but now you're doing them in brackets. Say, for example, here, the fixed or tangible asset note there, you get a fixed of like I'm expecting to get a figure there. You need to get a figure there, and then I'll give you information that will help you in calculating and getting that fixed asset amount there. You get it? So in instances like that, then it means what you have to open brackets, and then when you open your brackets, you do your calculations there. You get it? What then, like the question that I asked in the in the mastery boot camp today was that okay, so now let's say I'm doing the activity and there is like fixed or tangible asset that I need to start off with. Always make sure basically when you're looking at the information, what have I been given? So now I'm sitting there and there is no fixed or tangible asset note. You get it? But I am supposed to fill in this. Okay, so usually the fixed asset note looks like this. As you know, it always starts with you have a cost price, you put in a cost price at the beginning of the year, and then you minus your accumulated depreciation, and then you get what? That carrying value at the beginning of the year. You get it? And then sometimes, obviously, there might be additions there. We bought new equipment or land and buildings during the year, or maybe there were depreciations for that vehicle. You get it? Or maybe we sold some of it at carrying value. You get it? So these things will add part and parcel of additions and the movements in that asset that you have. And then at the end of the year, we have to account for the asset. So everything happened during the year. We had what we had in the beginning of the year, and then things happened during the year. What are we left with? You get it? So that's where now we are looking at the financial position or the balance in terms of like the fixed asset. How much do we have of fixed asset at the end of the year? You get it? So there might be instances that in the information presented, you are given the cost price at the end of the year, or maybe with accumulated depreciation at the end of the year, and expecting you to now like use that information to figure out how much is going to the balance sheet. So this means what? It means that maybe they might have like different assets. They have an equipment, they have a land and building, and then have vehicles. So in that case, then it means what? You would have to add all those costs of the vehicles, the equipment, and the land and building at the end of the year after everything else has happened. So you add all those three cost prices, you get it, and then add all those accumulated depreciations together, you get it. And then for you to get that carrying value at the end of the year, then you will say what? You say the cost price of all assets that we have in the business minus accumulated depreciation of all assets that we have in the business. That difference will be your carrying value at the end of the year that goes straight into your balance sheet. So this means what? It means that what I was talking about, you would have to do it in brackets, which means that in the brackets there, you will open your brackets and be like, add all the cost prices of all these what is it, assets at the end of the year, and then you minus the accumulated depreciation of all these assets at the end of the year, and then that difference will go straight to your balance sheet that side, your figure there, and then you're done. Okay, and then there will be instances here because like our non-current assets, that it's not complete. There is like things like your financial assets. So we were able to go straight to the financial assets, a bit of it during our AMA session last week. So in instances where now you have to account for financial assets, remember when we're looking at the financial asset there under non-current assets, we're usually looking at what? That fixed deposit or that fixed investment that is not likely to be maturing within the next 12 months. You get it? Sometimes they'll tell you that we have a fixed investment stuck somewhere. You get it? And then they tell you that a part of that investment is going to be maturing. If we're saying it's maturing, we're saying it's expiring from that investment. It means that it was locked up. You get it? But a certain portion of it, it's going to be taken out. You get it? From that mature, like from that fixed long-term investment. You get it? So if that a portion of it is going, we will have access to it within the next 12 months, then it means that that portion is no longer a non-current asset portion. You get it? So it's taken out, and therefore it means what? That portion then will be part and parcel of our current assets. I don't know if it makes sense. So it means that if it's 100,000 is fixed, it's going to be there in the next for the next 5 years. It's locked up, and then suddenly, out of that 10, like 100,000, you find out that 30,000 of it we will have access to be able to withdraw it in the next 12 months period. So it means that that 30,000 then will have to be taken out. So we'll say what? We'll say 100,000 minus 30,000, which means that we are now left with 70,000 still locked up. That 30,000 now will go straight in our current assets. This means that under our current assets, we'll have what? Investment or short-term investment. It's up to you how you phrase it. Others times you might, like if you're given something like this already, you get it, the template is fixed like this, then it means what? That 30,000 will be part and parcel of our cash and cash equivalent. You get it? So under our cash and cash equivalent, then we open our brackets and be like, whatever amount that is for bank, and then you say plus what? Plus that 30,000 of fixed investment. You get it? That investment is now going to be part and parcel of our short-term assets. I don't know if it makes sense. Okay, and then once you're done with that, then you will total that, and then whatever total that you get in, you'll put it as non-current assets there at the top. Okay, I just want to use something easy to use so that you see exactly what I'm doing. I always feel like when I'm talking, sometimes it makes a bit more sense when there is something moving, like we can do it. Like I was saying, then you will have your financial assets as you see here. So financial assets plus our fixed assets or tangible assets, then you will get what? Your non-current assets. So something that looks like this. Okay. And then now we can move on to our current assets. So what's going on in our current assets? So our current assets here, we'll have to account for our inventories. So usually when we look at our inventories, usually they say that stock count, if the business did a stock count, like they will tell you at the end of the year they did a physical stock count, and then they found out that this and this amount was for stock at the end of the year, then it means what? It means that that stock count amount will impact my inventory. You get it? So I'll put in, if it's 2,000, then I'll put in my 2,000 there, and then see if there's anything else that would that happen that sort of impacted my inventories. You get it? Maybe it happened that like the things that were not accounted for, like what is it? There's yeah, returns. So if there is an instance whereby customers were not happy with things and they returned some of the things, or we're not happy with some things and then we decided to return them back to the suppliers, you get it? So those are going to be impacting my inventories. Or maybe it happens that we had inventory surplus or a deficit, you get it? That deficit or that thing, you get it? So it's like the things that are impacting my inventory, how are they going to be impacting my balance sheet as well? You get it? So I have to figure out a way and sort of like work them out and then figure out how much exactly is my inventory. You get it. But however, all those things that I'm saying, you have to pay attention to figure out if they have been accounted for or not accounted for. Okay. And then once we're done with that, then we move on to the cash and cash equivalent. So what goes on in our cash and cash equivalent? So it's very important then to just be like, okay, so I'm in my cash and cash equivalent. So the most important thing now is for me to know that, okay, what exactly constitute my cash and cash equivalent together. So then it means what? It means that I should be in a position to be able to answer this question by looking at, like, I know that my bank account. Okay, so with the bank account, it can be tricky also, but the bank account would go under my cash and cash equivalent. I'll caution you, however, that when it comes to your bank account, you focus more in terms of, is it favorable or unfavorable? Okay, so here they're telling you that bank account 31,500 is unfavorable. So if you find out that the information says that the bank account is unfavorable, then this means what? It means that this is an overdraft. An overdraft, it means that we didn't have enough money in our account, so we decided to take a short-term loan, basically. Like we withdraw more than what we have from the bank. So that then becomes what? It becomes a liability. You get it? So now we are owing the bank money. So this overdraft will also be charged interest. You get it? So this is a loan. So this is no longer what? It's no longer an asset, but it's a liability, which means that this bank account that is unfavorable, which is an overdraft, then it's no longer going to be part and parcel of my cash and cash equivalent. But that overdraft would go straight to my my current liabilities. You see, here I have bank overdraft. You get it. So this again, the 31,500, which is a bank that is unfavorable, will be my liability, current liability. So it will go straight below, which means that it's not part of parcel of there. So it means what? When you are doing your cash and cash equivalent, pay attention to the information around bank. Is it favorable or is it unfavorable? Okay, so we're done with that. And then now we move on to what else is part of my cash and cash equivalent. So everything that is like money, you get it, we'll go straight there. We have cash float. So cash float, then it means that like this is basically change. If we're selling, we must have money that is easily available. You get it to get change, or maybe if we're selling, you get there's so many things around petty cash, like cash float, sorry. And then we have petty cash. Petty cash is for this, like in case we need to pay for something in the business, you get it? That easily available money for the business to meet those short-term obligations, like easily available cash, because sometimes we can't go to the bank all the time. If we want to buy something, you get it. So there must be cash that is easily accessible, basically. You get it? So then you will put it there. So this means what? It means that here, based on the information given, the three things that I'm going to put here in this regard is either I'll put in my short-term investment, my cash float, my petty cash. You get it? If the bank was favorable, then I'll also include the bank there. But in this case, the bank is unfavorable. So it means what? I can't put it there. All those things, you're doing them in brackets. Okay, and then we're done with that. Then we move on to the trade and other receivables. Okay, trade and other receivable, usually there is a note that you need to like calculate using the note. However, there are instances whereby like in the exam, I don't give you the note and I expect you to do the calculations in brackets and not using a note. So that can be tricky for a lot of learners, but it can be doable as well. So first thing first is like, okay, I'm looking at my anything else that is an asset. You get it? Assets, things that like money that I'm easily able to get a lot more faster. So I'm looking at the information that I'm given here. Already, I'll look at my trade debtors. So trade debtors is like my debtors control. You get it? Where are my debtors control? So I'm looking here and I'm not seeing any, okay, I have my debtors control here, but it seems like it's a question mark. So I'm assuming here there is information provided for me to work out how much are the debtors control. So I'll put in my debtors control and look at my provision for bad debts as well. Like how are they impacting my trading stock, which means that that difference that is there, then I'll say my debtors minus my provision for bad debts, which means that Debtors control minus my provision for bad debts will give me that net trade debtors. You get it. And then once I have that, then I can just look at what? Look at anything else like accrual, accrued income. You get it. An accrued income is an income that we should have received. But even at the end of the year, we're still waiting for this money to come through. You get it. Someone is renting an apartment from us, you get it. And they should have paid rent before the end of the year, but they still have not paid the rent. But we know that we will get that money, and there is an expectation on our side to get that money. And because we have that expectation, then it means what? It means that that is an asset for us. So then it means what? Okay, I'm just going to do that. Let me see if I can just add in the words to make it easy for people. Make sure that you're also like using, you're writing down the notes. So here I will say my debtors, so debtors plus my debtors minus my provisions. So minus my provisions, and then equals to my net trade. Okay, my net trade debtors. And then now I have that, which means that then I can say plus my accrued. Okay, my accrued income, not expense. Okay, accrued income. Okay, and then my prepaid expense. This is an expense, but I paid it before the time. Okay, prepaid expense. I paid it before the time. So it means what? It means that whoever I paid to, they're still owing me a service. So until the service happens, they are carrying an obligation to meet my benefit. You get it? So I have an expectation to receive a service from them. So this means what? It is an asset until the time passes. Okay, it's just like when you pay rent and then you decide to pay for 2 months. Like it's October and then I pay for October as well as November. You get it. So that means what? It means that that rental place or that landlord owes me the money until after the date. You get it. So there is an expectation for me to receive that. You get it. So then there is that. You can close. It's okay. And then yeah, so that is all in like a nutshell in terms of your debtors, trade and other receivables. So it's like the trade debtors and any other thing that we're expecting, or there's an obligation, like not obligation, a benefit. You get it, an expectation for a benefit to flow into the business. Okay. Looking here, there isn't anything else, so we can close this one off. So we close it off and then we move on to getting the total assets. So to get your total assets here, obviously, okay, before we go into the total asset, then in this what? You add all these things here, your inventories, your trade and other receivables, your cash and cash equivalent, and then your short-term investments. So you add all this and then you get the total there as current assets. Okay, and then once you have your current asset there, then it means what? You will say non-current asset, the one that you worked out there at the top, is, well, what's happening? Here, the one that you worked out there at the top, and then you add with your current assets. That will give you your total assets. Okay, so current asset plus your non-current assets will give you your total assets. Okay, and then once you're done with getting your total assets, then we can move on to the next thing, which is our second side of things, your equity and liability. So equity and liabilities, you have owner's equity here. So owner's equity is divided into two. So your owner's equity here, you will have to look at what? You have to look at your capital. So your capital, and then you also have to look at your current account. Current account. So what goes into my capital? What goes into my current account? Like I said, there are many instances whereby you get activities that you are required to work out, and they're not giving you activities or like opportunities to do the notes because we are used to the notes. So now it's like, how do I complete like a balance sheet without the notes? You get it? So here, in terms of the capital here, it will usually be the balances at the end of the year. How much is partner A sitting at the end of the year? How much is partner B partner B is sitting at the end of the year. You get it? And then you add together those amounts at the end, and then you get the total there. So this means that if I'm looking at partner A, maybe partner A added in term like added during the year to increase their capital, or maybe partner B decreased their capital during the year. You get it? And then you have to add those two together, the totals balances at the end, and then you get the amount that's going into your balance sheet. And then you move on to the current account. So current account usually, like I said, if it's not given or required for you to work it out, it's like, okay, I wasn't required for me to calculate. So this is usually going to be the balances at the end of the year. It's like balance at the end for partner A, balance at the end for partner B. And then you add those two together, and then whatever that you get, the total adding those two together will give you the balance posted to the balance sheet. You get it? Obviously, sometimes if we don't require you to do this note, then there might be extra information that you might have to take into account and somehow figure out get that balance that must be posted into your balance sheet. Okay. And then we can continue and then we're done with that, which means that once you have your capital as well as your current account, then you can add those two together and then you get your owner's equity and you put it there. Okay, so now we're moving on to the non-current liabilities. So non-current liabilities, you will have a loan. Usually it's a long-term loan. Okay, I'm just gonna put long-term loan because it can be confusing. Long-term loan. So this loan, we have like a bond. Sometimes depends. You find out that they have like an agreement and you're gonna be paying this for the next 30 years. Obviously, the 30 years amount that is owing, it's going to be reduced every year. It's like the more we pay, like at the end of year one, it means what? It means that the loan will have 29 years remaining. However, that 1 year out of the 30 years, it's now a short term portion of the loan, which means that that amount can be paid within the next 12 months. You get it? However, the remainder of the 29 years is not due immediately. You get it? So then it's like we keep reducing it every year. Okay, I want to find something here and see if we can just make it like work it out because that's an easy side of things, but it's challenging for a lot of lenders. So now we need to figure out like how would we work it out in this instance. So here they've given us information. They say loan statement from Kabeja. And then they've given us, like they say, the balance at the beginning of the year is 692,000. So the balance at the beginning is 692,000. So then I would then put in the amount. So this is like at the beginning of the year. So the balance at the beginning, you usually put it there, 962,000. You get it. And then we then be like, okay, so the balance at the beginning, it's that. So when we open our books at the beginning of the year, we were owing 692,000. Okay. And then there's interest. So interest was capitalized. And then they're showing us that the interest is like, for example, here, it's like 20,000. So it's like, okay, so it means that we will add 20,000 on top of what we were owing. Okay. And then how much did we pay? You get it. So we need to figure out how much then was paid. We don't know how much was paid here. However, we do know that the balance at the end of the year was sitting at 662,000. You get it. So somehow we need to figure out how much was paid here. You get it. So you can easily find how much was paid by just saying minus 662,000 here. You get it. So if I do that in my calculator, I think, let me see, 692 plus 20,000 minus 622. So this means what? It means that 50,000 was paid here. So all I'm going to do here, then I'll say plus 20,000 minus 50,000, something like this. You get it. And then yeah, so this will give me 622 and 62,000. So then the question is how much of this amount then is actually the short-term portion of the loan. You get it? We need short-term portion of the loan. So this means that the short-term portion of the loan here is supposed to be a 70,000. Why 70,000? It's like 50,000 was paid, which means that the 50,000 is reducing the original loan amount that was taken. You get it? Plus what? Plus interest of 20,000 that was also paid. for this loan. So this means that it means that 70,000 is what is actually what was paid. So basically it means what? It means that the business paid 70,000, and out of the 70,000, 20,000 was paying the interest and 50,000 was reducing the amount of the account that we owe. I don't know if it makes sense. Okay, so I'm going to give you a moment to just process what I was talking about around the loan, and then I can continue around that. I don't know if you noticed, but we are almost done with this statement, which is quite good. Okay, the overdraft, we were able to figure it out and we put it there. So the question now is what goes into our trade and other payables? Okay, so it is important to also know that in terms of your trade and other payables, then okay, just a second, just want to check something here. Okay. Okay. Okay, I'm done. Okay, I think I missed something here. Okay, so the saying here, okay, I know I missed this one. They said the repayment for the next financial year will equal to 1.5 times the portion paid over this financial year. Okay. So this is a very important information. So it means what? Every year we pay 70,000 in terms of the loan. However, things are different this year. This year, we are going to be paying less than what we were paying. You get it? So this means what? This means that we are just going to be paying what is it? More like 50%. I'm just going to double read what I'm just saying. So the payment for the next financial year will equal to 1.5 times the portion paid over year. So basically, okay, I get it now. So it means what? It means that we're paying the 70,000, obviously. However, with that said, we are now this year we are actually going to be paying a 1.5 times. So it's like 70,000 paid plus a 50,000 plus a 50% of it. So this means what? It means that that one was paid for. Okay, with that, but now it's just like we're only paying for 45,000 here. Okay, so this means that this amount here is supposed to be a 40,000, 45,000. Okay, and then this means what? It means that here, this extra information we will only be taking care of it now. So it's like, okay, so the balance that we're sitting at now after paying for this year. So we pay for this year and then the balance at the end is sitting at 662,000. You get it? The 70,000 has already been taken care of. And then now we need to take care of what? That extra 45,000 that they're talking about. We decided to pay an extra 45,000. So that extra 45,000, as we're taking care of it, then it means what? It means that we are left with 617,000. Again, it depends case by case. It means that if this extra information was not mentioned, we were going to do it the way that I had showed you previously. You get it? So you will say the balance at the beginning plus any interest that was there minus how much that should have been paid, which means that that balance at the end will be then what is shown in the long-term portion of the loan. You get it? And then that interest of 20,000 plus that portion that was paid, the 50 plus the 20 will give us the 70,000. You get it? So usually you will do it like that. Okay, we're done with that. Let's move on to the trade and other payables. What goes in my trade and other payables? So it's like here, all my other liabilities that don't have a separate account for, then I'll put them here. So trade and other payables, then I'll look at my creditors. How much am I owing in terms of creditors? So I look at my creditors here and I have creditors control here of 83,200. So I'm like, okay, good. I have my creditors control. Okay, what else do I have in terms of my um my liabilities. I'm looking at everything that I'm owing, but I can pay within the next 12 months. I'm owing, but I can pay it within the next 12 months. It's like, okay, I have my creditors control, I have my accrued expense. So why accrued expense? Okay, creditors control. So accrued expenses are those expenses that I should have paid for. But even at the end of the year, I still haven't paid this expense. You get it? So this is an accrued expense, should have been paid, but it's still not paid. So this is what? This is an obligation on our side. It's a burden. I have to pay this eventually, and I have to pay it within the next 12 months. You get it? So it's a short-term current liability. You get it. So accrued expenses, I will add that as part and parcel of my um, trade and other payables. So these are my brackets. I'll look at how much is my creditors controlled, how much are my accrued expenses, and then what else? Let me look at, like, if it happens that there is income received in advance. So we got more than what we're supposed to get. A tenant, somehow they decided to pay us for this year as well as a couple of months in the next coming year. You get it? The fact that they paid us more than what they were supposed to pay us, we have an obligation on our shoulders to meet the service or give the service. So until the time passes, we have that obligation for that tenant, which means that if it happens that they decide to sue us, we have to pay them back the money. You get it? Yeah. So then we say income received in advance. Received in advance. So here we are done with the obvious. Okay. So then it will happen usually that then we are done with that. However, there are things like VAT, value added tax, happens because, like, remember, when we're taking VAT, usually we are collecting it on behalf of SARS. You get it? And that amount that is due to SARS will usually be an obligation for us as a business to pay it over to SARS. You get it? And then sometimes it happens that, like, we, as I mentioned, the like vet, we also have things like pay as you earn. As a business, we sort of have that responsibility to withhold. It's like withholding tax. So it's like we're collecting the payee from the employee's salaries and we're passing it over to SARS. You get it? So the pay as you earn here will be part and parcel of our trade and other pay. So SARS payee. So this one, sometimes you'll find out that you might have to adjust this one because there might be additional information around the pay as you earn. Like, for example, it happens that some of the employees, they had not been accounted for. Like, here, we have extra salaries general for December 2021. And then they're telling us that this necessary payment has been made except for payee. So everything else has been made, has been paid for, but the pay as you earn has not been taken into account. You get it? So now we have to do what? We have to take it into account. You get it? And here they have not given us, like, how much exactly is the pay as you earn. You get it? So this means what? It means that you would have to work your way around to figure out how much these pay as you earn is. Like, for example, if the net salary is 31,100 and the gross salary is 52,000, then I can simply do what? I can simply minus this, or like 52,000 minus the pension minus the medical aid, and see if I'm getting that net salary, which means that if I'm not getting that 31,100, then it means what? I can then take that balance and minus with the 31,100. That difference will be my pay as you earn, which means that that pay as you earn, then I'll have to put it here. You get it? Always look at the additional information when it comes to the pay as you earn. Sometimes it might happen that, like, the salary for this employee is also something that has not yet been paid. If the salary has not yet been paid, then it means that it is a liability. We are carrying that burden to pay that employee. And until such time passes, that amount will be part and parcel of our trade and other payables. You get it? Usually, then look at the additional information. Have there any necessary documentation been made? You get it? Has this been recorded? If it has not been recorded, then it means what? We have to take it into account. Okay, I think that's it on my side. Let me just double check what else I will have to take into account there. Um, Yeah. We have covered everything that we need to cover. So then it means what? Then you are in a better position of totaling your current liabilities. So you total your current liabilities, and whatever you're getting is your current liabilities there. And then to figure out then your equity and liabilities side, then it means what? It means that you add your um equity side of things with your current liability side. And that difference will go straight to your total equity and liabilities. That means that then that means that then yeah, whoa, what happened? Okay. We're almost done. Don't worry. Then this that then our total equity and liabilities will then be added together. You get it, and then when you add together, then you just need to make sure, obviously, that your equity and liabilities is exactly the same as your total assets. However, during the exam, you don't have time. I don't recommend that you pay so much attention trying to balance your balance sheet. If your total assets are not balancing with your total equity and liabilities, don't waste time. Move on to the next section. Okay. If it happens that maybe you get like 30 million in your total assets and then you get like 100,000 in your equity liability, it's okay. It's okay. Such happens. Life is life. You get it. Move on to the next section because exams it's a race against time. You get it. The more time you're wasting on one question is the more time, like more marks you're losing on other questions that you would have done better. You get it. So it's not a business of trying to balance the balance sheet. You don't have time to balance the balance sheet. Yeah, it should balance, but if it doesn't balance, hey, you're not the first person that you have a balance sheet that is not balancing. So you move on to the next session. So I'm going to leave it like this. And if you have questions, please reach out in the discussion forum. Otherwise, thank you so much for your patience. And thank you so much for like just keeping it going. That's it from me.